Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Yuval Selik, the co-founder and CEO of Promomash. Promomash helps consumer packaged goods, CPG product companies that put their products on retailers and e-tailers' shelves to manage all those retail and e-commerce promotions that distribution puts on them. It's a very complex game. It's very important in this low margin CPG industry. Yuval had a CPG product that he grew and met a lot of these challenges. So we're going to hear about the differences of CPG and the SaaS game, and he talks about his experience in both businesses and how he grew as an entrepreneur in both of them. In this interview, Yuval mentions how lonely it can be to be an entrepreneur and a founder and a CEO of a growing business. Whether it's going well or things are really difficult, it's always hard. And if you don't have team members you can share that hard stuff with, family members, neighbors really don't understand what you're doing, and you probably don't have board members as a practical bootstrapped founder, it can be really hard to get through the big challenges, whether they're challenges in your business or just the difficulties you're having carrying all this weight. That's why I created the Practical Founders CEO peer groups. Right now, we have 35 serious B2B SaaS founders on the road to 10 million in revenue and some beyond who get together every month to work on their challenges, share their victories, and get perspective to make better decisions in their businesses, to grow faster and create more valuable software businesses, and get more sane along the way as you grow. And you guys know how difficult that is. So if you're interested in being around other B2B SaaS founders, and I curate and moderate the groups myself so that I'm involved too, check out my CEO Practical Founders peer groups at practicalfounders.com. Welcome to the Practical Founders Podcast, Yuval.
Glad to be here.
Exciting. Where are you today? You're in your studio. I know you're a podcaster and do other things there, but where is that studio?
That studio is in beautiful Sedona, Arizona.
Oh my gosh, the red rocks and the canyons and the mountains and everything. I lived in Phoenix for 23 years. That's a couple hours away, straight up into the mountains there. What made you arrive at Sedona? I guess the natural beauty and maybe the peace that people have there?
No, I just escaped from LA.
You went east and that's where you ended.
Well, it happened during COVID,
Yes.
where we were locked up and crime was up.
Yeah.
Taxes were crazy. We were spending a whole bunch of money on a 2-bedroom small apartment and a noisy street.
Yeah.
And I told my wife, hey, let's go down to Sedona for a little break and see how it is. And we came to Sedona. We arrived to a nice little Airbnb.
Yeah.
And no one was covered and no one was locked up.
Yeah.
So we figured, wait a second, this is good. Less regulations,
Yeah, right.
less government, right?
Yeah.
Less taxes, and it's beautiful.
Yeah.
Why not?
Awesome.
Right?
And are you surviving the summers there? It's not as brutal as Phoenix, but it's a little warmer than LA.
It was brutal for the last couple of years.
Yeah.
I mean, Sedona usually is high 90s.
Yeah,
Maybe
yeah.
you get to 100 every once in a while during the summer, which is expected from desert environment. Phoenix is, I mean, you're boiling eggs and your sneakers are melting when you're walking down the street in Phoenix in the summer.
Yeah, and there's probably almost close to 6 million people in the Phoenix metro area. So yes, I get it. Well, I know we'll talk about this, but one of the reasons I survived in Phoenix for so long is I worked a lot and I was inside doing that. I wasn't, I spent a lot of my time working, building 2 big companies there, but, wasn't very balanced, you might say. So we'll get into that here. Yuval, why don't you just tell us about your current business? You've had multiple businesses, and it's a software business called Promomash. Tell us about Promomash. What is it, and who is it for?
So Promomash is a SaaS platform that helps CPG brands manage the chaos of retail. And so the way that I look at it, for those that are not familiar with CPG or consumer packaged goods, a brand, a manufacturer that creates a product, let's say it's an energy bar. They have R&D, they create the product. So that's getting on the shelf, right? There's a period of what you need to do to get on the shelf. Right. We don't deal with that part of it.
Yeah.
Now, once they're on the shelf, once they convince the buyer of the store to put them on the shelf, they have to sell off the shelf. Getting on the shelf isn't that difficult. It's the fun part. Selling off the shelf is the very difficult part that a manufacturer has to go through. And that happens through promotions, right? So in order to raise awareness, you have to promote, and there are different tactics. You can do an in-store demo or sampling. You've seen that before.
Yeah.
You can do a sale called a temporary price reduction, or a TPR, those yellow stickers. You can do a coupon. You have advertising. You have different tactics.
Yeah.
And so managing those tactics can be done in Excel or Google Docs, or can be done on a platform. If you're doing it in Google Docs and Excel, you probably have a 40-tab spreadsheet that takes about 15 minutes to load up. You don't have all the information in one place, and you're struggling to understand the data and the insights that you need in order to make better decisions in becoming more efficient as a manufacturer selling off the shelf. So we help you find the efficiency. We help you find the ability to understand your return on investment, to get a real P&L for a retailer or for a product. And that's what we do.
Okay. And you have a little background in the consumer products industry. You've made some products and got into distribution, got them on the shelf, and faced this yourself. We'll talk about your story there. Do you sell this to, is it small and new entrants in CPG, the consumer products that end up in grocery stores and other stores?
We really tailor to mid-size brands. So brands that are probably 10, 25 million and above. So brands like Poppy or Siete on the larger side.
Yeah.
And, smaller brands that are in the $25 to $50 million range are really kind of our bread and butter.
Okay.
The reason why we don't bring on board we do have many brands that are under the $10 million mark, is because when you're that small, promotional effectiveness is not top of mind, because you really are trying to gain distribution rather than affect the percentage of trade spend or efficiency.
Right.
And so our platform is not just a SaaS product. There's a service component to it, which means that we have experts in the field of trade finance, trade planning, trade analysis, and deductions, which are the charges that you get after the fact, right, when you promote. And that's very expensive for us to maintain, right? There's actually a lower gross margin for us than this pure SaaS product because we employ these experts. So that then our price is a little higher than you would find with a traditional SaaS. So we have a bunch of competitors who just are pure SaaS. And if somebody wants to just purely for price, right, save some money, then they would go with them. But if they're looking for quality, if they're looking for insights that's accurate based on expertise in the field, right, not just platform, then they would go with us.
And that all turns into better margin, better sell through, not wasting money on all these promotions that retailers pretty much force you into, right? Spending money with them, so forth. So, they're thinking about the bottom line at the end of this as well. Do big companies, the big brands that make Tide, Procter & Gamble and the rest, do they have teams that do this, like the big enterprise teams and specialists and data analysis people and their own software and all that magic?
Which is why we don't work with those companies. They do have their own teams, and yes, they do need platforms, and the platforms they use are enterprise level platforms like Salesforce and other providers. Now, the thing is, we don't want to get into that space because it's so customizable and there's so much pain to deal with the RFPs and the long sales cycles and all the issues that come up with handling such a complex account, that we feel like we have a niche in the $25 to $500 million range. And I think there's enough business to go around that should keep us pretty busy for a long time.
That makes sense. And part of distribution is online distribution, e-commerce. Is there any aspect of this in e-commerce that makes sense, or is it all retail, big bucks?
No, it's selling off the shelf,
Okay.
whether it's a digital shelf or brick and
Oh,
mortar
okay.
shelf, we handle it.
Okay. Right. Well, I'm old enough to have spent the first decade of my life in software in the 90s with packaged software in a box with discs and CDs and all of that, selling at stores. People walk into a store and buy a box. You tell it to kids these days, they don't understand.
Are we that old?
Yes, we're that old and everything. So
Oh,
I spent
man.
a lot of time in this game with Act Software. Sales Logics wasn't in the retail zone, but very familiar with that of the old days. And all the promotional games you play with that, to spend money to get in their newspaper ads, spend money to be an end cap, spend money to get a promo, spend money to train their salespeople, spend money to promote. And it doesn't matter if you build the boxes of the software and get them on the shelf. If they sit there, nobody's winning, and that's not your business. Everybody wins when stuff sells, and you don't spend too much on that. So I guess that's the game you're playing in the modern era for all kinds of products.
I think it's been like that since the age of business,
Yes.
right? Because ultimately, you can have the best product, you can have an amazing market, you can have the most incredible team, but if nobody knows about you,
Distribution.
you're going to fail.
Yes, right.
Distribution is key.
Yeah.
Now, it doesn't mean that if you have distribution and you have a crappy product, that you're going to do well. You kind of have to have it all,
Right.
which is why there's such a high turnover, such a high churn
Right.
in CPG,
Right.
because not every product is a good product.
Yep.
So you buy it once and nobody wants to buy it again.
Right.
And so you only have a certain runway to sell, even if you're spending millions of dollars in advertising or marketing. So you kind of have to have it all. And then you have now Amazon's great because you have an unlimited shelf, but at a retailer, you have a number of feet available to you. And there are large corporations that are vying for that space and are spending the money, and they have the distribution, so that, maybe a 20-foot, 50-foot shelf now for this little guy becomes a 5-foot shelf because the other conglomerates, and there's really like 5 entities, right, that own 80, 90% of the shelf.
I get it.
Right. And so what they're doing, which is really interesting. So for all you CPG folks that are thinking about starting a business, I'm going to tell you this. The way the business works, kind of the back end story. Large conglomerates don't want to spend money on R&D and all the shit that you got to go through in order to build up a product.
Yep.
So they're counting on someone like myself, a recovering CPG founder now, who wants to bet their entire life, their marriage, their house, their home, their savings on the R&D that is required to bring a product to market, and then the pain of actually bringing that product to market successfully. And if you are successful, they'll just eat you up.
Yeah.
Because the point is, it's much cheaper to have someone else go through the pain and the expense and just eat them up if they find the success where the market is validating that success.
Well, that's a little analogous to the software startup game and big companies acquiring. Although CPG has its own mechanics of startups and the dreamers that say, I'm going to make, a friend of mine's son is making a electrolyte product in a can, right? And getting on the shelf and playing that game and getting investors and the software mechanics, if you can do it without funding and get up in revenue, and you don't have to deal with a retail shelf and the limited distribution there, but you have to deal with marketing and selling. But if you can get it up there, there's just different mechanics in SaaS, and the mechanics in CPG are brutal. It takes more to build something, and then you have cost of goods to ship something and deliver it, and then you got to pay the retailer. I wonder how people succeed with this.
They don't.
Okay.
That's the problem.
Yeah.
I have many entrepreneurs who have a glimmer in their eyes, waiting to launch another energy bar or coffee or water. Like, we need more of those.
Yes, right.
and they come to me and they say, "What do you think I should do?" And my first advice is, don't do it.
Yeah.
unless you're so passionate,
Yeah.
unless you have something that's so unique and you're willing to give up 10 years of your life to potentially get to market and actually become successful, don't do it, because the chances of succeeding are really slim. And the reason why is because of trade spend. If you think about what it takes, so granted, you can raise a little bit of money from friends and family and manufacture with a co-packer
Yeah.
some sort of product. You can be charming and walk up to a buyer's office and say, here's my product, here's my story, I'm local, I'm giving a percent to the, to some foundation.
Yeah.
I'm all altruistic and et cetera. And the buyers say, oh, I love you. I'll bring your product in because
And there's
I just
clapping.
want you to
Yay,
succeed.
we got it on
And
the shelf.
they're clapping and everybody's happy and successful. They just got a big PO for $20,000. And they're, that hockey stick graph that shows, growth. Great. Okay. Then what happens is that the misunderstanding by the founders, by the CPG founders, that retailers and distributors have a very slim margin in selling your product.
That's the reality. They have basically no margin in the end.
Almost no margin. So basically, even though they take a 25% cut, right? So if you think about your margins, right? You start off with cost of goods, great. So now you have this margin. Let's say it's 80%, 90%, whatever it is. Then, and for smaller brands, it's actually lower because it's expensive to create and build and manufacture products at a low volume, right? But let's say you do a good job there. But then you bring in a distributor, that's an extra 25%, 25% on top of that. Then you bring in a retailer underneath that needs another
layers of distribution,
layer. Right? So now you're adding more. So now your distribution is crap. And then their distribution, even though at 20, 25%, they have to run their business. And running a retail supermarket is a very expensive proposition. They're not making money by your 20, 25% margin. So what do they need? They need to add trade spend, and they make it a pay-to-play game. So now they're saying, all right, Mr. Bar, Mr. Energy Bar, yes, you're giving me a margin to sell your product, but you're going to also have to pay me if you want an end cap or off shelf. You're
it's
also
not going to move unless
me.
You promote it. And
correct, and, and you need to do it, or else I'm going to discontinue you. So they put the fear into the founders' whole soul that they're going to get discontinued if they don't promote, if they don't buy the ad, if they don't get into absolutely. So now they're making their money in addition to the margin that you're giving them. So guess what? You want to guess what the top line percent for a brand to promote called trade spend at retail?
A percent. So I'm an energy bar and I say
you're any bar, any manufacturer, top line, you got your gross revenue. Right? From gross revenue, what percent on average is common in trade spend, not anything else. Forget about paying your employees
Safeway
and building
or the grocery store, right?
Just trade spend.
Okay.
For promotions,
10%, something like that. We were 10 to 15% in the old days.
The average is somewhere between 25 and 35%, with probably hitting about 27% of your gross top line revenue.
Right. So when you walk into a store, you know that all the promotions are paid for with extra investment, marketing spend.
Nothing is
trade
free.
spend.
Now, in the old days, when we launched our brand back in 2007.
What was that brand? Let's talk about your old company.
So I started my entrepreneurial career with a company called Luvala, Luvalla. It was an incredible product. It was a skincare line, organic, natural, certified, aromatherapy, vegan, animal cruelty free, every label you can throw at it, we had on our packaging. It was made in the south of France, and it was delicious and beautiful.
Okay.
And we launched it back in 2007. Back then, we didn't have the same expenses as they do now. We used to get free off-shelf displays at Whole Foods because we got into Whole Foods as an example. We didn't have to pay $11,000 or $40,000 to promote like they do right now.
Mm.
It still was very expensive, but it wasn't what it is today.
Holy cow.
And we still failed because even with 80% margins, we still failed.
And how long did you run that business? Did it get up into the millions and it, couldn't sustain itself, or? Yeah.
Overall, it was multi-millions.
Okay.
I don't believe we got over $1 million a year, but overall we made $4 or $5 million.
Yeah.
But it was a nice little business and it was growing. The problem is we didn't raise enough capital initially. We raised with friends and family about 1.1 million. By the time we had the packaging, we were probably through about 400,000 to 500,000 of that. I was paying everybody $100,000 salary, doing everything that a first-time founder would do. Right?
Sounds like a funded software founder.
Yes. It was a funded.
Yeah, right.
It was. Just money was printable at that time in my mind. So huge mistakes.
And of course, it's going to work.
Of course, it's going to work because I had that hockey stick business plan. And when I couldn't raise any more funds, 2008 happened, right?
Okay.
So what founders don't understand is you don't have many options or many chances of making a mistake.
Yeah.
You can make a mistake here, you can make a mistake there, everybody does. But as a small time founder, right, as a small brand, you make too many small mistakes and you're done.
Yeah.
Especially if a black swan event happens.
Yeah.
Now, black swan events never happen, right?
Except when they happen.
Let's say they do. And if they do, like the 2008 financial crisis or COVID, what do?
Yeah.
You need to have cash in the bank. So we have a formula now that I wish I followed. CPG is the formula. C, cash flow.
Yeah.
P, profitability. G, growth. To grow, you need to manage your cash flow and profitability. If you ain't profitable today, that's not a problem as long as you have a road to profitability.
Yeah.
But you need to have cash. If you don't have cash, well, you better be profitable. So there's got the two first.
Sounds so simple, Yuval.
Sounds so simple, exactly.
Yeah.
But it's true. So you can raise funds. You can raise VC funds and spend $2 to acquire $1.
Yeah.
That's fine. If you have a market that's going to sustain itself and continue to grow when you pull back.
Right.
Because you can't do that forever.
Right.
So.
Yeah, and that pullback, okay, let's get to profitability, which generally is, now we're a public company. We can't fake it anymore. We can't say we're over-investing in growth. I guess some public companies or even software are still, unprofitable, but mostly they get there, right? And by the way, sometimes it works, right? Facebook and LinkedIn and Google. Right? They invested and now they're the most profitable companies around, but mostly it doesn't pan out like people think.
When you have millions and millions of users, when your cost of goods is, when you're, and you can just acquire as many customers as possible early on and then cut your expenses and marketing budget because then there's word of mouth like Slack.
Yeah.
That's for sure a great business model.
Yeah.
And I think you should raise VC funds because you got to be first to market and you have to do your thing. But for 99.9% of the businesses out there, they are making a huge mistake by going VC.
Of course.
Huge.
Yeah. So let's, thanks for you're a vertical specialist in the consumer packaged goods, consumer products that end up on the shelf, and serving that industry is and the tier of industry that you described. Where is Promomash now with your, software that manages all that trade spend and all that complicated stuff to be more efficient? How big is the company? How many employees? How many customers?
So we have hundreds of customers. I mean, over time, we've probably serviced over 500, almost 600 customers. Right now, we probably have about 170 or so on the books. We are a 125-person team.
Oh my goodness!
As the latest count and growing every time because we do offer a lot of service. And we're in the millions, so we've been very successful. I mean, we wouldn't say we're 8 figures, high 8 figures, but we're getting there. And I think that the ability to learn from my prior mistakes allowed me to become a successful company today.
And do you have any outside funding at all?
No, We have friends and family. We've raised
It's a little bit.
I
Yeah,
think
sure. Practical.
even with, I mean, you had to, and during COVID, we started the company with $14,000, 7,000 myself and 7,000 my co-founder.
Yeah.
We built the company to, a little bit, probably a million or so with just that. Then we raised with friends and family, maybe about $300,000, $400,000, which is very little.
Yeah.
We utilized that for growth. And then when COVID hit, we had to, because here's the thing. When we first started Promomash, it wasn't about promotions on the trade side. It was more on the field marketing side. So when COVID hit, we lost 80% of our business.
Does field marketing mean like people who go to stores and help it move?
People who go to stores. Yeah. So we were helping we were helping brands manage the folks that are walking into a store.
Yeah.
So their schedules, their reporting.
Yeah.
And when COVID hit, and we were doing really well, we were going triple digits every year. But when COVID hit and no one was allowed in store, right. We lost 80% of our business.
Okay.
So we had to pivot into our trade side,
yeah.
which is now where we are. We still have our field marketing platform, but that never regained the same momentum that it had prior to COVID.
Okay.
For some reason, brands are not promoting field, in store with people as much as they were in the past. At least that's right. What I see right now.
I get it. I could see that happening. So you're not quite 10 million in software revenues. Is that right?
Yep.
And and you've got over 100 employees, and you don't have a lot of funding. Yes. So I'm guessing you're profitable or break even or something like that. You're not.
We are profitable.
Yeah,
yep.
Great. So how do you run a business like that? Are these people that help out, help the retailers and build your software and do support and everything? Are they in other parts of the world, and you've got teams that can, of efficient people, India or someplace like that?
We're fortunate enough that we live in a world where we could outsource or have a team that is outside of the U.S. We've actually started the company being remote and working with the Philippines back then when we first started. We've managed to keep culture alive and really have an incredible culture despite being fully remote. We are now in 12 time zones. So the ability to utilize effectively the workforce is an incredible opportunity for us because we can do more with less.
Yeah, that's right.
And everybody's happy because we pay very good wages where the locations where those folks are. Right. It's just not the same wage that a U.S. person would.
So you have this trade spend management platform, and you have a couple hundred customers. What do all these people do? You don't have 100 developers, do you? Or 100 people in sales, or 100? I mean, you've got developers and salespeople and things like that. But what else? What else? What's in there that I'm not seeing?
So the largest team that we have is on the accounting side of the business. So if you look at it, we manage the expenses that come forth after the fact. So let's say a brand would agree to and contract to a promotion. That promotion might cost them, $1,000.
Yeah.
Okay. But they don't pay $1,000 up front. What happens is that 4 or 5 months later, the retailer or distributor will just reduce the amount of the check that they pay by that amount.
It's not even an approval thing. It's just, we'll take it off the top. Yeah.
You take it off the top. So that's where the issue lies. A brand might expect $50,000 from an invoice and get $5,000.
Yeah. Right.
Because they don't know exactly when.
Right.
It's a nightmare. And so they can't even plan their cash effectively. But in reality, the managing of the coding, validation, and dispute, because a lot of times those deductions are not valid.
Yes.
So we have to dispute. So that team that manages that service is our largest team because it's a very manual process. Even though we have AI and we have machine learning and all of the algorithms, you still need folks. And the reason is because it's a profit model.
Yeah, they're trying
for the distributors.
Get as much out of this as possible, and you don't have leverage in the game. You're bringing leverage back to these low guys. When the retailer and when Whole Foods says, it was this much 6 months ago. Tough.
Yep.
Right.
Exactly.
So there's a little bit of a managed service. Service as a software. We have people who will do some of this. We'll look at the invoices. We'll look at the data. We'll make recommendations things like that. So there's a little bit of a tech-enabled service element in there. Is that a version of what you're selling? It's not just a platform, but we'll help you, sort through all this stuff.
We have a pure platform play.
Yeah.
So they can, if they want to,
Yeah.
just, subscribe to the platform at a lower price. Yeah. The thing is, we have a unique model where we bring in the team if they need it.
Yeah.
So if they need the support because they're a small brand and they don't want to hire very expensive trade analysts or production specialists, then our team manages it for a much more efficient and effective price for them, right? On the other side, if they don't need it, if they're a larger team, then they can manage it themselves internally.
This podcast is brought to you by my friends at Fullscale. 2 years ago, I interviewed 3-time software founder Matt Watson on this podcast about his successful practical founder journeys. Matt leveraged offshore software development talent in his last 2 SaaS companies to staff up quickly and grow efficiently. So for his 4th venture, Matt created Fullscale, one of the fastest growing software development companies in any region. Fullscale vets, employs, and supports over 300 professional software developers and testers in the Philippines who can augment and extend your core dev team. I know several practical SaaS founders who use Fullscale's dev talent to make progress on their products and do it efficiently. Visit fullscale.io to learn why their approach works so well for so many SaaS founders. Now back to our program. I know several SaaS businesses that have the platform, and then you can do it yourself. And then everybody's, or a majority of that market says, we don't really want to do this ourselves. And we're not going to be successful with your product if we don't want to do it yourself. So they get into the we'll help you do it game, this, tech-enabled service game. And it turns out to be a really great model. We're there when you need it. We'll get it done. I mean, this is the promise of AI, is it's actually going to do the work on top of all this run your business software, but and all of that. But I've seen that work very effectively for this, mostly software, but a little bit of tech-enabled service, on the margin to make it work better.
Well, I remember the days where we subscribed to Salesforce.
Yeah.
And Salesforce as a CRM.
Yeah.
And Salesforce is a remarkable company. They're very well established, and they have every bell and whistle that you can possibly imagine, even though most of their clients maybe use 5 or 10% of their software. But let's say that you subscribe like I did to Salesforce, thinking that I'm just going to, with my small team, ramp it up,
figure it out,
get it set up, and onboarding will be quick and swift and easy. Quickly, you find out that you need a PhD and an analyst to get you to switch a field because it's so complex. Yeah. It's the same thing with trade. You can have a platform with all the bells and whistles, but if your team isn't qualified to manage trade, you are not going to be successful no matter what platform and no matter how good the platform is. And speaking about AI,
right?
Okay, AI is a evolving field right now, and I love ChatGPT. It's making me 10x, more efficient as a founder, as an executive. That being said, it hallucinates often. And what do I mean by that? You ask it a question, it gives you an answer, and that answer seems very, very
it's very confident.
Very confident.
Like a good sales guy. Yeah.
And then, it's like, exactly, like a great sales guy. And then all of a sudden, you realize, wait a second, that is not the correct answer. And you correct it saying, hey, ChatGPT, this doesn't look right. Here's what I know for sure. And what does ChatGPT say? Oh, I am sorry. Thank you for helping me learn the correct answer.
Yeah, training. Yeah.
Imagine putting up your entire P&L and your expense projections on an AI currently, pure AI or platform play, to give you recommendations and to solve your problems that pertain to 25 or 30% of your top line expense.
Right.
That is not a smart thing to do, my friend.
Yeah.
Not at this point.
And is that because, as I hear from many founders, and I could see this, um, it's great for storytelling and narratives and things, but for financial data or medical data where you can't be 1% wrong, right, or 10%
Exactly.
wrong, that this kind of probabilistic approach, not the coding deterministic like a spreadsheet or code, right?
Yeah.
The numbers won't be wrong if you've coded it right. It's just not close enough yet.
It's a predictive model.
Yeah.
That's all AI
Yeah.
is, right? AI has multi layers. It has the natural language layer where it talks to you and
Yeah.
it's fun, and you can have my co-founder treats it like a best friend.
Yep.
So he has hours of conversations with ChatGPT on philosophy and physics and
Yeah,
science
all
and
right.
whatever
That's
he
right.
wants.
It's magic.
But that is a predictive model, which means it's all about probability of what the next word is,
Yeah.
right? What the next phrase
Yep.
is. Then you have machine learning. That's another aspect of AI, more complex, right? But it learns by doing, right? So it continues the formula, and as you continuously feed information, it learns it. So that's machine learning. And then there's algorithms. Algorithms are going to be your most effective and trustworthy number that you get out of algorithms because they're formulas.
Yeah.
Machine learning is your next predictive model. And then natural language, which tries to bring in some of those pieces together, is your third.
Yeah.
So from my understanding, and obviously it's evolving. So if someone's listening to this 6 months from now, it could be completely different, right? Because AI is so quickly evolving. But today, I would not trust my business with any, and we have competitors that are touting AI only software. I would not trust my business with any AI provider right now because I can't verify that it's going to be accurate. And it's a black box of unknowns, and I just don't know.
So
I'd rather have folks with experience validate and ensure that this is correct.
And where are you with that? I mean, are your teams who do this complex, number crunching and analytics and sleuthing of what is it? Is it really this? Is it that? That kind of thing. Are they using AI to help them through this?
Oh yeah. We started AI a long time ago. So we started machine learning and AI and algorithms a long time ago. We use it as a tool. We use it as a support system to become efficient, which means that what's the point, right? A brand can just hire a team. Why hire us? The reason is that we're about 10x more efficient than their own team, which means we're going to be more cost effective.
Right.
And the reason why we're more cost effective, not because there's less folks on the team, it's that our folks can do more because we have the tools.
Right.
But we still validate and we still understand that the data is super important.
Right.
In software, there's a saying, garbage in, garbage out. And you want to make sure that the inputs are accurate. And in order to understand that the inputs are accurate, you need humans with experience with the tools that are available to validate that the tools are accurate and they're not hallucinating. Then the outputs that the tools still provide still need to be reviewed by the humans to make sure that it makes sense, asking the right questions, and then conveying that information to the client is super important as well.
And it can't be close. It has to be right. Do you view that you, in a couple years, because of your knowledge of these complex processes, your training of this, doing it over and over and over again, that you could train between your data and the guardrails for AI and the pre-training, all the examples and the conditions and so forth, that you're going to have an advantage to do more and better with AI than competitors that aren't, let's say, personally training, the AI next to them?
Yeah, I think, again, we're never going to get out of the human business model because AI or machines or just technology. Think about what happened. I'll give you a great analogy on this, right? I'm old enough to know a phone-less, Facebook-less, Instagram-less society, right? environment.
Yeah.
And the funny thing is, I have more friends today than I can ever imagine. I have thousands of friends, yet I'm lonelier than I was when I was
Magic.
pre-social,
Yeah.
right? So what's happening is human nature. We tend to go and look at the shiny new object and be attracted to it, and then as a crowd, as a sheep crowd, right?
Believe the hype.
As sheep,
Yes, right. Yeah.
just move to that new shiny object, and then figure out, wait a second, I'm lonely. I need a human, right? So that's what's happening now. The fastest growing tech-enabled business are communities, like real human communities, not social media, not Facebook.
Well, I'm
If
in that
anything,
game
Facebook
myself.
is probably
I'm with my CEO peer groups, 35 founders who spend time together every month working on their hard stuff that they could ask ChatGPT, what do you think I should do? And it's not that
exactly.
accurate. And it really doesn't help frame your mind and keep you sane, all that good stuff.
You need somebody to just talk to sometimes,
Yeah.
and you don't want to talk to a robot, right, all the time.
Well,
Now, granted, maybe some people would,
Yeah,
but
yeah.
for the most part, that emotional connection that you have
Yeah.
is really difficult to
Yeah.
maintain with a computer.
Yeah. So let's talk about Promomash, the business here. You had
Mhm.
this deep knowledge. You understood the pain. You went in and was doing the field marketing stuff, and then you pivoted during COVID to more of the complex trade spend. You went into the black hole of this really important and very complex area, and you figured out something. Do you have salespeople that knock on the doors of all these CPG brands of a certain size and say, "Hey, we've got this solution"? Is it a sales-led growth, or are you marketing to them, your potential customers, or how did you grow this business up successfully?
So we have a marketing team.
Okay.
We have a sales team, although for many, many years, even till recently, I was one of the few sales
I
folks
bet.
as a founder-led
Yeah, and an
salesperson, which I
expert.
think,
Yeah.
and I think that's actually the right move,
Yeah.
right? If you're a founder and you don't know how to sell your product, you probably should
Yeah.
not start the business, right? Because ultimately, you're the one that has to bring folks initially into your organization and make them believe that there's something that they want to fight for,
Yeah.
that they want to join as a group, as a tribe. Then you have to bring on clients and sell them the dream before you're ready. Because ultimately, no matter which business you start, whether it's a tech business or a CPG business, it doesn't matter. It's always a chicken and egg situation where you don't have the product ready
Yes. Yeah.
to bring in the sales
Yes.
that would pay for that product. So you have to be able to be charismatic. You
Gotta
have
fill the
to
gap.
be able to fill the gap. Exactly. You have to be able to sell the dream,
Yeah.
sell the story, and bring in the early adapters.
Yeah.
When you bring in the early adapters, that's where you learn. That's where you create, that's where you enhance your product, you enhance your offering. You actually learn what your business is about. The most difficult part in any business, and this is my second business, and I can tell you, second company, the most difficult aspect of running a business is actually being able to explain what you do in an elevator pitch.
Yeah.
Like really explain what you do in an elevator pitch. People might say, "Oh, you've been running this business for 10 years and you don't know, how difficult it is to come up with a tagline, just do
I
it."
do. Yes.
It is
Been doing that for a
impossible.
long time. Yes, right.
Yeah. It's so difficult. And understanding the strategic direction where you're going, because strategy is not, and I'm going to repeat this because I think folks need to understand, strategy is not, I have the best product, I have the best service. So basically what I've learned over the years, if you have to say best, most, beautiful, take that out and just say product and service. And then ask your competitor, do they have a product and service? And they'll say yes, which means you don't have a competitive advantage. You can't say best because everyone's going to say they have the best. You have to be so unique in your strategic advantage and your messaging that you're going to avoid that red ocean
Yeah.
and jump into a blue ocean. And that's why so many brands and companies fail, is because they're a Me Too commodity. And that's the problem. They don't know how to distinguish themselves from their competitors?
Well, this is a lesson of my early years that, of course, the consumer packaged goods has to have a clear, simple message on the shelf or a 30-second advertisement on TV or a blip that comes through on our social media.
Yeah.
You don't get a
Yeah.
lot of space to
No.
explain and say it's kind of this, it's kind of that, like we do in B2B SaaS
Yeah.
when we're sitting down with somebody. You got to have a pointed, differentiating, unique, and valuable
Yep.
message for somebody. What is that
There are two.
message
There
for
there there are
Promomash?
two. There are two that come to mind. Just to
Okay.
interrupt you,
Yep.
there are two that come to mind. RX bar.
Uh-huh.
Okay, an RX bar is an energy bar, right? Or just a nutritional bar
Yeah.
that's on the shelf. How did they distinguish themselves? Initially, they were a package good that was the same as every other packaged good on the shelf. And then the founder said, wait a second, why don't I change the packaging that just says RX bar and label the ingredients on the front? So 2 dates, 5 oats, 2 eggs, like in big letters. And that became a multi-billion dollar success or $1 million success. Same thing with water.
Yeah.
How do you bring a new water to the market, right? These days, when there's how many waters?
Yes.
You create a name that's called Liquid Death.
Yeah.
And when you have Liquid Death on the front of your packaging and you're on the shelf, do you think you're not going to get noticed? You're going to get noticed. That's the genius between understanding why you're different than everyone else and being able to explain it.
And
right?
and why is Promomash different than, say, the other competitors in the simple elevator speech here?
It's really about the platform plus service aspect, right? So it's being able to take in what everybody has, which is platform and regular support, right? And then making sure that there's an expert team that then allows more support to the brand.
Okay,
right?
great.
And the reason is because it's so complex and so difficult to manage people that most companies don't want to have that service aspect.
I totally agree.
Plus, that service aspect brings down your gross margin.
Mm-hmm.
And if they're going to raise funds, they need that gross margin to be in the 90s.
So they need to push
and
that
you'll never
off,
get there.
right?
So they do not want to bring in the service aspect. And I think that's what differentiates us.
There you go.
Plus we're creating an incredible efficiency score that will transform the market, the industry as we know it, because it's like a credit score for your trade effectiveness and efficiency. So because we do everything and we have the right folks and we really understand the market and we really understand what it takes to become successful, we created a score, like a credit score that has multiple parts, a benchmark, multiple parts with different weighted averages and algorithms that is trade secret to us. And our brands will be able to manage their score on a quarterly basis with an expert who's going to be able to tell them how to improve that score.
There you go.
So-
And I totally get it. I mean, if you're dealing with no margin left over, and it's the difference between improving your margin, at the end by 10% in a consumer packaged good is the difference between life and death for most of these growing companies.
If I even do it 2 to 3%,
Okay.
it's going to make a huge difference.
Wow. That's awesome.
Yeah.
Okay, so let's keep going on the business here. About how much does a customer pay you a year? Is this 10,000 or 50,000 or 100,000 in this hybrid?
It really depends.
Okay.
For obviously SaaS platform only, it's much less. But we our minimum usually starts around 3,000-4,000 a month.
Okay.
For smaller companies, and it goes up from there.
Yeah.
So obviously like a Poppy or a Lundberg Farms, these multi-$100 million a year clients are going to pay more than a $10 million brand.
Right.
But we don't do it by seat. We don't do it.
Yeah.
We do it by usage, right? Base. So
Yeah.
the larger you are, the more you pay.
Yeah.
And unlimited seats, and just that's what makes it, a friendly environment on their wallet.
Right. And, does this mean that you kind of drift up, meaning the more revenue they have, the more margin improvement you can bring them in absolute dollars, the more they'll pay, and the bigger clients have the biggest, upside for your, for value?
I mean, we're talking about unit economics here. And so basically, think about this, we try to average a recovery rate, a recovery
Yes.
rate for their trade spend of about 5% of their trade spend. So think about this: $100 million brand or $1 million brand. Let's say 20%
Yeah.
is trade
No, I
spend.
get it.
Out of that 20%, we can recover to their top line, pure profit, 5%.
There you go.
Just that alone, forget about the insights, the support, the knowledge, the experience, the advisory,
Bottom line.
the ability to all of that. Just that piece alone, there's probably around 200 to 300+% ROI for our services. So that's the beauty, is that no matter what you do with Promomash, there's a guaranteed ROI because we don't charge as much as we would get back for that.
Yeah.
Now, obviously, if it's a really small brand, yes, it's tough. But the larger the brand, the bigger the ROI.
Does that mean you're drifting up, as most software companies do and have done?
In terms of client base?
Yeah, drifting up market.
So I think right now we're very comfortable in the, up to $500 million mark. I think we will probably get to $1 billion or $2 billion as we develop our platform to have more features.
Right.
But we're not going to go above that for the long term. I think we want to stay in our lane. We don't want to be all to all people.
Yeah.
We want to be the best at what we do. And in order to do that, you got to know who you are, you got to know who you're serving, and you got to know how to solve their problems. And if you continue to move upstream, you have new problems you got to deal with. So you're always solving new problems rather than fixing and going deep into problems that you need to fix.
There you go. And obviously, there's probably 10 times more of the little guys in CPG trying to climb the ladder than the few big ones out there.
Yeah.
Do you have competitors that are VC funded in this trade spend management category?
Boy, do we do.
Okay.
Yeah, we do. We have one competitor that raised $62 million. They're a pretty new company, about the length of time that we've been in the market. And there's another company that has raised, I think, 15 or 20 million. All I can say is that I know for sure that one of them is in a world of hurt.
Yeah, of course. If they're not growing to sustain that ambition, it's very painful.
When you raise $62 million in 2 or 3 rounds, there's an expectation of growth the investor needs to get their money back plus, right? And if the market isn't there to support it, which there isn't that kind of market.
Yeah.
See, the thing is, in CPG, there really isn't that much of a VC market because
it's not that big.
it's not big enough, right? There's only, how many thousands of brands, but then out of let's say there's 5,000 or 6,000 brands out there. Out of 5,000 or 6,000 brands, how many need your product? And then basically out of those folks, you have to distribute it amongst your competitors. So you don't have 1 million folks. You're not going to be $100 million brand unless you really scope out of your niche and what you're doing. And that's very expensive and very dangerous because then you become, an inch deep and a mile wide.
Yeah.
And you're no good to anybody.
That's right.
So that's really, the catalyst of why we did not raise funds.
Yeah.
Because we decided that I don't want to have the pressures of somebody on my board telling me that I have to grow 50, 80, 100% year over year, where sometimes you need to pull back in order to fix your product. Sometimes you need to push forward and step on the gas a little bit. So, but that decision needs to be my decision, not the, VC's decision. And so the folks that raised funds in our, market, in our competitor landscape, they're not run by their founders. They're run by their investors. And that is not a good way to run a CPG brand with investors that don't understand CPG.
Yeah, the old saying, it goes back a long time, is when you raise VC funding, you inherit the business model of the VC. That's because that's the game you just signed up for, which is you need to hurry up and grow and spend more money and raise more money and grow faster. If it doesn't work, see you later. We're off the escalator. Yuval, with a company that's growing like this, and you've got hundreds of employees, do you have a senior leadership team, a finance lead, a sales lead, a marketing lead, a development lead? Whether they're VPs or C levels, do you have a senior leadership team that's pretty full now?
Of course. I mean, we have my co-founder and I and our CTO/COO. We're kind of in the executive
Okay.
level, but we have a very strong senior leadership team on
Oh,
the
great.
VP level. And they're the ones that are, they always say that shit flows up. And the best way of knowing that you have a great leadership team is that shit stops at a certain point before reaching you. So the mark of a great business is not how valuable you are to the company. It's actually the opposite. So there's a founder's curse.
Yeah, of course.
The founder's curse says that the more valuable you are to the company, the less valuable the company is. So if you can take a vacation as a founder for a month, come back, the business is growing and you're doing well, you have a great company.
Yeah.
If you can't leave for a weekend, you got a problem. And you got to solve that problem.
Yeah.
So
And every acquirer knows this. And that's about the systems and processes and the factory
correct.
that you build that runs and can handle challenges on its own there. Um,
Yep.
what is the most important metric in your business? You help CPG brands with their deepest complex business, challenge in the financials. What is yours? Are you watching the gross margin? Are you watching growth rates? Are you watching net operating cash flow? What are you watching that says if we keep doing more of this, it'll be great?
Right now, we obviously have a revenue goal that we're trying to meet
Yeah.
in 3 years. We also have a net margin or an EBITDA number that we're looking for.
Okay.
In order to achieve that, we have to look at two metrics. One is efficiency per employee, which means revenue per employee. Second is gross margin.
Yeah.
So gross margin is your efficiency, right? And the net, the revenue per employee is also efficiency. So that's going to cover the EBITDA.
Yeah.
And then the other metric that we're looking at is obviously new MRR and churn.
Yeah.
So if you're looking, because we don't really bill on an annual basis, but so really it's the P&L, stupid, right? That's kind of what we're looking at. So revenue and expenses, right? If your expenses are in check and your revenue keeps on growing, you're a good company.
Yeah.
If your revenue stalls and your expenses keep on going up, that's a problem. So you have to understand your P&L. I think that's the most important, not just for us as a software company, but for all of our brands.
Yeah.
That's why a P&L is the number one report that is extremely valuable. And you should be able to take that P&L and slice and dice it by your product, by your people, by your customers, et cetera.
Yeah.
That's going to be important.
Yeah. And you show up in the profit and loss, the revenues and expenses, and what's left over every month. You show up helping your customers, improve their P&Ls.
Yep.
How did you learn? You understood the CPG math and the business model there. How did you learn the SaaS math? It's different, obviously.
It is different. And there are metrics that, we cover with our CFO. We have a fractional CFO that we work with. And he's an expert in CPG.
He's the one who connected us. So let's
SaaS.
give him a shout out here.
Correct. Yeah. So go ahead. Give him a shout out.
That's Ben Murray, who's been on our podcast here, who's helped a lot of SaaS founders. So he has a lot of courses to help people with their SaaS metrics. And he works with a few companies that he wants to work with that is to really that difference between, okay, here's the raw SaaS data and here's really how to run your business through it.
And Ben's been great. I mean, he really understands the SaaS environment and he's able to help us understand the metrics. But in general, I've known basic business financial, metrics that every CEO should know. The CEOs or founders shouldn't know everything, but they should know the basics. They should know the numbers that make the levers that they can pull on, right, in order to run their business. They shouldn't trust their CFO for that.
Right.
The CFO complements them, but they should have a basic understanding of a P&L, of a financial statement, right? Cash statement, balance sheet, P&L.
Yeah.
Those are your three. If you understand them, then you can, the question you need to always ask yourself is, how could I be profitable on the P&L yet have no cash? And if you can explain that, then you understand your financial statement.
There you go. Right. Yuval, what would you like to do with this business? You have some friends and family investors who said someday this will be worth something. We'll pay you back for that. But do you want to run this for years and eventually sell it, or what happens as this keeps growing and improves?
At this point, I want to continue to add value to my clients to make sure that we're building something that is generational,
Yeah.
that is something that is going to withstand the test of time, and that we can feel proud of later once we're no longer part of the business. Obviously, an exit of some sort is really nice because I don't really want to work for the rest of my life. I'd like to, cook.
Yeah. Okay.
'Cause
There you go.
I'm an avid chef.
Yeah.
I'd like to host parties and cook, and just travel.
Mhm.
But in general, I'm not against staying on for a little bit, but I'm always going to make decisions based on the information that I have at the current state
Yeah.
of my business. And sometimes if the data shows you must sell now
Yeah.
or else you're going to be in trouble,
Yeah.
then you sell.
Yeah.
And if the data says, you know what, keep at it
Yeah.
for another couple of years, 5 years, 10 years, and you'll do way better, then that's the data you go off of. You do your best every day.
Yeah. That's kind of the superpower of practical founders. You have the optionality, you have the ability to change your mind and
Yep.
do what you think is best if you get tired or the
Yep.
market changes or something like that, or you could go longer. If
Yep.
you raise your competitors who've raised funding, they're on
Yeah.
one track. Hurry up, or we're gonna
Yeah.
kill you, right? And
Simon Sinek talks about the infinite game and the
that's right.
finite
Yes.
game. And so the infinite game, you make different decisions as a founder than you do with the finite game, because a finite game is by quarter.
Yeah.
An infinite game means that your business stays around
Yeah.
generationally.
Uh-huh.
And so what decisions are you making if you have
Yeah.
to
That's right.
make them on a quarterly basis versus a long-term 5, 10 year, cycle? So
Yeah.
we're looking at it from the infinite.
There you go.
Game.
Yeah, and you've learned a lot with your previous business and running this one about not just the business game puzzle of financials and product and all everything else that goes into it, but the founder human side, the people side. You have a podcast called Seven Hats, and
Mhm.
you talk about let's say the sanity and health and balance of founders. Can you say a few words about that? We don't have time to go into much detail, but like people should know that there are resources like this out there that are useful, talking to entrepreneurs about the head game, the challenges, the opportunities, the paradoxes, the normal
Yeah.
human stuff that we go through that can be quite painful.
Well, in 2011, I found myself in my bedroom holding a copy of Eckhart
Yeah.
Tolle's New Earth, sobbing uncontrollably because I was about to lose my wife, everything I've ever worked for, my health, my spiritual connection to my higher self. Everything was on the line and I was about to lose it. And I was in a major panic attack, and it was my
Because your business was
rock
struggling and
bottom.
put you in a corner.
Business
Yeah.
was about to close.
Mm.
I was about to get a divorce. I risked everything, and I didn't have any safety net,
Yeah.
so I didn't have a job lined up. It was a really difficult time.
Yeah.
I'm writing a book right now that's going to be launching in 2026, and so I go deep into that. But over time, as I rebounded, I figured out one thing, and that is if you spend all your time as a founder on your business is likely to fail. And the reason is because you have 7 categories in your life that are super important. That's hence the 7 hats, 7 categories of life. And if you don't pay attention to the first 3, which is what I call the soul, which is mindset
Yeah.
and mental health,
Mhm.
the athlete, which is sleep, nutrition, and movement,
Mhm.
and the servant, which is your relationships, you are not primed to spend time on your business effectively because you need those 3 in order to succeed. Otherwise, if you lose your relationships and you lose your health and you don't have a good mindset and you have mental health issues, is it really worth climbing that ladder? Because what you're going to find is you're going to climb this ladder, you're going to have all these accolades, and maybe even your business is successful, but you figured out the ladder's on the wrong house.
Mhm.
And that's the problem. And the second thing you figure out is that you don't like the person that's at the top.
Mhm.
So in order to really figure out how to not burn out and find fulfillment rather than achievement in your life, you have to focus on the 7 hats in the 168 hours that you have during the week, and with a juggling act,
Yeah.
not juggling. You don't juggle. There's no balance, right? It's a balancing act.
The act.
And the balancing act basically says that some weeks your business needs more of you than your family does.
Right.
And some weeks your family needs more of you. But ultimately, you're planning out your week based on your 7 hats, and you're touching all 7 hats so that when you do get to the end, you're not on antidepressants and you're not miserable.
Right. And your business is one of the hats, as I understand it.
Correct.
Right.
Hat number 4 is the entrepreneur.
Right. Yes, that makes sense. I think it is one of the great things about practical founders. We talked about the optionality there. They're doing this hard, crazy work, but they're not on the treadmill of, the VC funding game. Got to go all in or you're out. We have founders in our groups that are businesses are doubling every year, and they're still coaching their kids' soccer games and working out, and they're busy, but they're juggling, I would say, and they're not giving up on that. I would say the first 15 years of my career, I sacrificed health
Yep.
and relationships with my family, and many other things. So it's a different.
That's why we do what we do, to avoid, right? To help others avoid
Yes.
the 10, 15 years of pain
Right.
that they go through to just realize what we already have figured out. And that's why I always suggest that young entrepreneurs find mentors who have done it and been there, and listen to them. If it resonates, listen to them, because you don't want to go through the same pain.
Yeah.
Avoid it.
Yeah.
So
Where can people find out about your 7 hats, the buckets that you juggle?
well, there's multiple places. LinkedIn is a good place to find me.
Okay.
Just look for Yuval, Yuval, Selik, Selik. You can go into yuvalselik.com. I have a website, a personal website. You can go into promomash.com, promomash.com, which will get you to, if you're a CPG founder, find me there. But in general, I think LinkedIn is a good place. I'm pretty active. I post every day. I add some value.
And you have a podcast.
And you can connect me there. And the podcast, which is the 7 Hats, you can find it anywhere you listen to your podcasts. And you can go to THE7, the number 7hats.com. And that would be where all the podcast shows are. But in general, again, everything's on LinkedIn, all the links and everything. So it's just easier there.
Awesome. Yeah, I listened to one of your podcasts with somebody, an entrepreneur I know. Jeremy Shapiro had a help desk software and a long career, but he was part of the Infusionsoft ecosystem way back when. And he's a deep thinker about business and about life, and learned a lot of lessons. And I really enjoyed that episode. A very practical founder, for
Thank
sure.
you. Appreciate it. Appreciate it.
Yuval, what advice do you give to founders most often, like the practical founders who are listening today, the software founder that says, you've got this thing up and running, I'm thinking about this, or I've got some revenue and some getting on the field and growing towards 1 million or 3 million or 10 million in revenue. What advice do you give them most often about the winning the game as a founder?
Don't grow too fast. Just understand, spend the time to understand who you are as a business, what drives you, what fuels you, how you're showing up in the market, how you're helping your current clients succeed. And always, the fake it till you make it is great, but always grow slowly and get to that next chasm. Across the chasms, that's fine, but don't go too fast, because if you're going to cross too many chasms, and you're going to find mature clients who need your services, but you're not ready for them, that's when you ruin your reputation. That's when you have a lot of stress on your hands, and you might fail because of that.
Yeah.
So stay in your lane. Don't be all things to all people. Don't grow too fast. Remember the formula, C plus P plus G. Growth is dependent on your cash flow and profitability. Don't grow if the first two are not aligned.
There you go. Very practical advice. And it's not really possible if you raise VC funding, any of those things. The growth rate is there and profits are not there. And the control and not getting ahead of your skis, right? That
Yeah.
there's the fake it and make it. You got to eventually make it,
Yeah.
right? That's what
The
real
the
businesses are.
the way I look at VC funding, it's great once you understand and know who you are and are able to scale. If you have a process and systems where you can leave the business for a month, the business flows and still continues to grow, and you know exactly what everybody does and how they do it, and where you're manual and where you're automated, and you maximized every aspect of your business. And now you know if I raise $1 million, 5 million,
Yeah, that's
100
right.
million, I'm just going to scale.
Yeah, and
That's
it
when you
will
raise
work.
VC
Yeah.
funds, and that will work. If you do it any other time, don't call me crying on my shoulder because it will be
Yeah.
painful 100% of the time.
Well, a real practical founder message there. So thanks for that, Yuval. Thanks for sharing your story of Promomash and the 7 hats and everything you're doing to help all those crazy CPG founders who have the dream and are building real companies out of that. So thanks for being on the Practical Founders podcast.
I appreciate it so much. Thank you. Thank you, Greg.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.